Once again, ladies and gentlemen, boys and girls, and children of all ages, you're now tuned in to the Investor Show. As always, this is the gracious host, the Prince of Investing, Prince Dykes, coming to you guys and girls live all the way from the beautiful city and state of Denver, Colorado. I'm currently streaming this live on my Facebook pages. If you're not following me on Facebook, check me out on Prince Dykes MBA, the Investor Show. Where else am I at? Royal Financial Investment Group. Those are pages you can find me on Facebook, but I'm also going to be uploading this into YouTube as well. So we're going to have a pretty live show today. We're going to talk about unemployment, stock market rising while unemployment continues to rise. We're also going to look into Uber and Lyft earnings. That's going to be a cool part we're going to do today. We're going to break down Uber and Lyft earnings as well. But if you're coming in and you want to say hello, definitely feel free to say hello while we are, if you're catching this show live. But also you can catch the show on iTunes and Google Play and iHeartRadio, all the other great stuff. So we're going to have a pretty good conversation today. And that's pretty much it. So the first topic we're going to get into is we're going to talk about unemployment rising to 14.7%. Every Friday, the first Friday of every month, we get unemployment numbers. And on the first Friday of every month, as you get unemployment numbers, we're going to say, okay, here we go. LaShawn Hebert Edmonds said, hey, I got my book, thanks again. So she won a book from the Robert Kiyosaki interview. So I hope she enjoys the book. I think the book was called Who Stole My Pension? So glad you got it. Thank you for tuning in and thanking you for winning the show. So sometimes, a lot of times when my guests come on, sometimes I give a little pop quiz and I may give away a book or something like that or whatnot. So glad you won it. And I'm glad that you can see that I am a man of my word and I do deliver. You know, you don't want to be the person, how you doing, Miss Michelle Thompson? But one of the things I want to jump into today, unemployment rose to 14%. And as unemployment rose to 14%, the question I wanted to ask, not the question that I wanted to ask, the thing that I wanted everybody to acknowledge was, everybody's wondering, man, as unemployment continues to rise, why is the stock market continues to rise as well? So the thing about it is, when people invest, you don't even invest from what's happening today. You invest in what's happening tomorrow or the future. If someone come to me, it's a new startup, I'm not looking at them as a new startup. I'm looking at how much money can they earn me potentially in the future, right? Or how much money will the company earn in the future? So the stock market is a leading indicator. The stock market is a good indicator of telling you what's to come. So when you're looking at what's happening today, you're like, well, we're not in a good time right now. Why is the market continues to move or moving sideways? So I don't think the market's really going up. I think it's mostly going sideways. And what I mean by that is simple. It's not really shooting up. It's not really shooting down. It's going up a little bit, down a little bit, up a little bit, down a little bit, or it's kind of staying the same. So what does that tell me? That tells me that the market in the future, it is uncertain. When the market is uncertain, they don't know if it's going to go up or go down. The market is going to jump one way or the other, right? Whether it's going to jump up in about a month or so, or it's going to go down in about a month or so. So, and why? How do I come to that conclusion? We've seen the market hit the bottom, I think it was March 20th, when it hit the bottom of 18,000 points. And we saw that because everybody was assuming all the things that you're seeing today, the market is already accounted for about a month or two ago. Everybody already knew, oh, the economy is shutting down. They already knew unemployment was going to go. They already knew corporate earnings was going to suck. They already knew all these things. People started to predict what was going to happen to the market. So the market was acting off of the future, not for what's happening today. So the market started dropping massively. We saw massive fall off starting the February, March timeframe. February and in March is where it bottomed out at. And it's kind of been on a little slowly upward creep a little bit since March came along. So what does that mean? That means that now we're seeing move sideways. That means that the future is a little uncertain, that it can jump one way or the other. Prince, how can I profit from the current market or where the market may go? I would say if you was a person, you could go out and you could buy, you can straddle the market one if you're an option trader. You can straddle the index. You can straddle the index fund if you're an option trader, and pretty much you're waiting for the market to move one way drastically in another. So right now, everybody's uncertain. We see the economy kind of opening. We don't know how things are going to shift. So the market is kind of waiting to see how things are going to pan out. That's my interpretation of what I'm seeing right now, right? So that's kind of why you're seeing nobody's paying attention to unemployment, jobless claims. Millions of people are filing for unemployment. Millions of people are filing for all this other good stuff. But you're seeing this stuff continuously go up. And you wonder, man, why is this stuff still going up? And the reason why it's still going up, because all the stuff that you're seeing today, all the unemployment numbers, all the business shutting down, the corporate earnings, people were already expecting that over a month ago, right? So that's the first thing. Now we want to get into something that's good, that's fun, that everybody want to talk about. So just last week, we just had Uber and earnings. I mean, not Uber and earnings. Uber and Lyft reported their Q1 earnings. Q1 is quarter one 2020 earnings, January, February, March, right? Earnings are very important to a company because we have the opportunity to see what's going on up under the hood. What is Uber looking like up under the hood? What is Lyft looking like up under the hood, right? You know, as you become a serious investor, if you're a speculator, if you're spectating, a spectator is someone who just look at a price of a company and just speculate on what's going on. As you become an investor, more serious investor inside the house, you start to look at financial statements. And as you look at financial statements, you start to do portfolio. You start to do ratios. What is the ratios? What is the ratio for what you call it? What I'm trying to say now. Some people may ask the question, what is the ratio? What is the ratio to debt to income? What is the ratio for ROA, not return on investment, return on assets? What's return on assets? What's debt to income? What's debt to equity? All these different, what's the growth rate? All these rates that start to come out of a financial statement. And you're pretty much looking at the bank statements of a company. So Uber and Lyft reported that quarter one. As you know, they're both in the same space. I believe that the space is going to turn into like social media. It reminds me of everything with social media. When social media came out, it was like this. When Facebook was the first one that hit the block, and everybody said, hey, you going to buy some Facebook stock? I'm like, what? MySpace just went out of style. Now you got this new thing called Facebook. What is this? This is just a website. You crazy. Now look at it now. Now you got Facebook, which went off and brought Instagram. Now you got Snapchat. Now you got Twitter. Now you got all these guys that are out there roaming around. You know, YouTube is pretty much a social media too. YouTube, Facebook, Instagram, all this social media is pretty much running the world. And they're running the world more now in the coronavirus. There's more people on these platforms. If you look at Google earnings and you look at Facebook earnings, you will see that more people are using social media now. So when I look at Uber and Lyft, it kind of reminds me of that new company that I don't know what may happen in the future, right? So let's start looking at it. So let's start breaking it down. First of all, let me get in here with everybody saying hello. Miss Michelle say hello. How you doing? Melanie, I got it right. I know I always got to mess up her name, but how you doing today? Did you get your book? I know she won a book as well. Eddie P, what's going on? He said thanks for sharing. Anytime. Oh, you're not locked. Oh, deep story about that, Stephen West. They didn't like when I streamed in the Berkshire meeting, right? I will be back on my YouTube, but they didn't like when I did that Berkshire meeting. You know, Verizon. While I was streaming, they emailed me. The people at Yahoo Finance, shout out to Yahoo Finance. They're good people. They help me out or whatnot. But they thought I was taking away their streams, which I guess I kind of was, but I don't think I was taking away their streams. I think I was helping them out. Right, but this is going to be on YouTube anyway. This will be on YouTube anyway. So, but yeah, Miss Jacqueline. Okay, how you doing, Miss Jacqueline Golden? She says, "Hey, how you doing?" Facebook said, "Thanks for sharing." Okay, got it. So let's jump straight into what we got going on. So the first thing we're going to look at the total assets of Uber versus the total assets of Lyft. And why we're going to look at this information is the first thing we're going to look at is why total assets are important. Total assets are important because with me, that's the way I can gauge how big a company is. So let's say if someone has a total assets of $1 billion versus another company have total assets of $2 million, doesn't mean a whole lot, but it tells me just sometimes by a company being big, they have a competitive advantage. For prime example, Coca-Cola, just by Coca-Cola being worth hundreds of billions of dollars, they have a competitive advantage over someone who's starting out. They have a competitive advantage over smaller companies. People like to buy and do business with things they heard of and know. So if I try to start a drink company or whatnot, I will have Coca-Cola, just by being Coca-Cola, has a competitive advantage. That's why total assets, not say they mean a lot, but that's why I pay attention to total assets. And also, so when we're looking at total assets, when you're looking at total assets, it tells you how big a company is. Prime example, I was watching a show on YouTube channel the other day, Valuetainment. Shout out to Patrick Bet Davis for coming on to the show. If you haven't checked out his interview, he was here for, I don't know, a couple days ago, last week. So one of the things, he was interviewing somebody from, I think, Tyson's, the meat company. And he was saying that it's very hard for a new competitor to come into the meat company. Either you got to marry into it or you got to inherit it, pretty much. He was saying that because you just can't compete. You don't have enough money to be able to compete in the meat market, right? Because some companies, just by being big, have a competitive advantage. So some companies use their money and their assets as a competitive advantage over another. So let's take a look at the total assets of both companies. Now, by the way, this is coming from SEC.gov, Security and Exchange Commission.gov. This came from their 8K filings that both companies did last week. This pretty much their 10Q, the quarterly report. So if anybody want to look up the information, follow it. I always teach people how to fish. That's how we do it. But I wrote a lot of this information already down because, I'm weird like that and I read and study stuff like this. So as of March 31st, 2020, Uber reported $30 billion in assets versus Lyft reported $5.5 billion in total assets. So when you look at that number there, that tells you that Uber is about 6 times bigger than Lyft comparatively to their assets. Just how much money, how many assets the companies have, right? So total assets are going to go to Uber. That gives them a competitive advantage just because I'm bigger than you. That gives me a competitive advantage over you. Just like if you want to start a social media site, just by your social media site can be 10 times better, but Facebook, just for the name alone, is worth money. So when a company's that big, when I look into that space, the ride share space, there's only 2 companies that's out there really juggernauting, and that's Uber and Lyft. And when you look at Uber, Uber is the big guy. So total assets go to Uber. Now, the next thing we're going to boil down to, we're going to look at gross profits, right? The gross profits is, okay, once the person makes their money, just like you bring home your money, once you pay your taxes and all of the good stuff like that or whatnot, who has the most gross profits left over? The gross profits who have the most gross profit left over is Uber. Just to the sure fact that something that we're going to get a bit, I should have walked into this earlier. I don't know why did I do that first. But let's do to revenue. So let's get down to the revenue. We look at revenue. Uber reported $3.5 billion, right? $3.5 billion in Uber. I want y'all to laugh at me. Sometimes I watch my video over, I'm like, man, my lips was ashy. But it gets dry up here in Colorado. That's where I'm at. So we look at revenue. $3.5 billion goes to Uber versus Lyft has make sure I get it. $3.5 billion. They have $955 million. So Uber probably made about 3 times more, or not probably, but they made up 3 times more than Lyft. So Uber is about 6 times bigger, and they made 3 times more than Lyft. So right now, by looking at the numbers, you automatically can see that Uber is a bigger company, right? The next thing is you're looking at the expenses. Why revenue? Let me get back into it. Why gross profits and revenue is important? That's very important. That's on the income statement. The income statement, that's very important because I want to know how much money is coming in. How much money are you making? Who's making the most money? That's pretty important to know, right? And when we just spoke about total assets, this is on the balance statement. This is the balance statement. So you got 3 statements: balance statements, income statements, cash flow statements, right? Balance statements tell you what's in the bank. Income statement tells you what's coming in. Cash flow tells you what's coming in and out on a particular day. So hopefully that's not what you call it. Now that's gross profits. We're looking at who's bringing home the most money. So now let's go into cash. who has the most cash on hand? Prince, why is cash important? Cash is very important to me for one simple reason only. When a company has a lot of total current assets, that means to tell me that a company current assets tells me how fast can you get your money that you need. For prime example, right? Some people like to say, I got $1 million. Some people are millionaires, but they can't touch $1 million. They have $1 million of net worth, right? This person's a millionaire, and guess what? They have 400,000 tied up in the real estate. Then they have another 300,000 tied up into some stocks, a stock portfolio, whatever the case may be. And they may have another 2,000 put into a 200,000 put into a business, or whatever the case may be. And they may only have 100,000, 200,000, but they are a millionaire, right? So the thing about it is, if something got bad, if something got very bad, when a company needed capital like coronavirus, something got very bad, how fast can you get to your cash? This is a category called total assets. I'm not total current assets. Current assets means something I can liquidate within less than 12 months. For prime example, if your money is tied up into bonds and all type of crazy mutual funds and you can't get it, it's not as liquid. So I want to know how much money can you liquidate right now today, and to be able to pay for whatever you need to pay for. So people don't lose current ratios because current ratios tell you how fast can a company pay off its current debts. So the first thing I look at is Uber reported 11 billion versus Lyft reported 3.1 billion, right? So right there, that means to tell me Uber has 3 times more its current assets than Lyft does. So that's pretty much cash in the bank, or money that can be converted to cash within 12 months. So Uber wins that category. Now we look at profits. Both of these companies are unprofitable. Both of these companies are taking losses right now, right? So for prime example, Uber reported a loss of 2.9 billion. Uber's kind of burning through about 3 billion a quarter too. Lyft is taking in, they reported a loss of 398 million. So Lyft, both of the companies lost, but Lyft lost, they reported a net loss a whole lot less than Uber did. Uber lost 3 times much as Lyft did. So this is the profits. Both of these companies are unprofitable companies. When you look at the finances, these are not ideal companies to invest in. Why they're not ideal companies to invest in? Because they're not profitable. You have so many other companies that are unprofitable with no debt. So when you look at it, profits, Lyft takes the cake because it lost less money. Even though both of them are losing, both of them are unprofitable, Lyft reported a smaller loss. Now we got to go to brands. This is something I can connect to total assets. Now, granted, just because you have big total assets doesn't mean you have a stronger brand. It's my belief when I look into the rideshare industry, the rideshare space, I always see Uber has a stronger brand than Lyft, in my opinion. One, the factual number that I can pull up is total assets is a bigger company, but that's not always true. But I just feel as though Uber, tell me if you disagree, but I feel as though Uber has a stronger brand. What does it matter, friends? Why does a brand matter? The brand of Coca-Cola does not reflect on the balance sheet. It doesn't say, oh, my logo is worth this much. The brand of Coca-Cola itself is worth billions and billions and billions of dollars, right? If I had going back to, if you take a Coca, say if I had a soda company, a drinking company, people will do business with Coca-Cola over me just because of the brand, right? People will do business, sell businesses. They will do more business with a bigger brand than a smaller brand. A more Coca-Cola is one of the top 5 brands in America. So it's Disney. So I can create an amusement park, but it's not Disney World, right? Disney has a lot of assets. It has a lot of brand equity that we can't see represented on the balance sheet. So if I had the line of Uber's brand, Lyft's brand, and the rideshare space, who do I think has a bigger brand? Is Uber. And we're going to get a little bit further to that as well when we get down to revenue streams. The next topic, revenue streams. Revenue streams are very important. This is something that hurts Facebook, even though it helps Facebook at the same time. Facebook has reported 0 debt, and it has a cash pile, I want to say about 40 billion or something like that, right? Great. But when you look at revenue streams for Facebook, Facebook only has one revenue stream, and that's advertised on Facebook and Instagram. So if that got disrupted some type of way, it's going to be a long long time for Facebook to be able to not come back, but it's going to be hard over there. If something happened with Facebook advertising, if they can't make their money via advertising, that scares me. Only one revenue stream. Versus if you look at Lyft and Uber, Lyft makes its money through rides. One revenue stream, one trick pony, right? Uber, on the other hand, it has several revenue streams. It has rides, it has Uber Eats, and it also has Uber Freights, right? So it has three ways that it's earning this money. It's actually another one called Uber Bets or whatever it was. But they at least have 3 or 4 revenue streams. And why that is important, during the coronavirus, while everybody slowed down on rides, guess what they saw a surge in? What Uber said. Uber saw a surge in people delivering food. Guess what Uber has? Uber Eats. So now, with the COVID-19 going on, Uber Eats has a competitive advantage because it has Uber Eats versus Lyft is only doing rideshare. So now this is another thing. The fourth piece, not the fourth piece, but the next piece is called guidance, CEO guidance. The CEO of Lyft, you know what they said they're going to do? They're going to downsize. They're cutting employees. They're furloughing. They're cutting customer service. Lyft is saying they're downsizing. Uber, on the other hand, what does this say? Uber says it's downsizing, but it's also going to put focus into Uber Eats. It said at this time, Uber Eats is really seen a surge in people using Uber Eats. So they're going to put more money there. Sorry, I got the hiccups there a little bit. So that's the way you look at it. Now, the other thing is, this is what you got to go into. Now you got to start to do the debt-to-income ratio, the debt-to-equity ratio, the debt ratio. Why am I very important to debt? Because just because a company is bigger and it has more debt doesn't mean it's doing a good job for debt. I want to see who's managing their debt the best, who's managing their money. Because if you got 2 people, if I make $100 a month and somebody else is making $100,000 a month, but by the time they pay all their bills, they're negative, but I'm positive, then I'm a better investment when it comes down to return on assets, right? So I just don't look at if you're a big company, but I want to see how you manage it. So when I did the debt-to-income ratio, the debt-to-equity ratio, we got Uber is doing a better job at managing their debt. By looking at the debt-to-ratio, the debt-to-income ratio, and return on equity ratio, Lyft, I meant to say Lyft is doing a better job of managing debt. They're doing a better job of growth. They're actually growing year to year. They're growing more than Uber is growing, even though Uber is way bigger. So they're doing a better job of managing debt. They're doing a better job at year-to-year growth from last year to this year, even though both of them are still losing. And even though it's a smaller company. So now I got to come up with it and I say, okay, well, we saw the 2 companies. Which company will I label as the winner? Now, the company that it's a very hard toss-up now, which it was much easier before. But at the price, when I look at the stock, both of them are pretty much the same price. Actually, I think Lyft is a little bit more. But for the price of if I was to invest $30 today, I would put my money on Uber over Lyft. Even though Uber is way bigger, Uber is way bigger, its stock price is less. Now, when it came down to the return on asset ratio, they wasn't that far off. I got return on assets is 0.07 for Lyft and 0.10. So when it's return on assets, that return on assets is telling me how good are they using their assets to fund their growth, right? Their net earnings. How they're using their assets to produce earnings, I meant to say. So I produced and I saw that I liked it Uber a little bit more. Who said? Lashandra says, "This is great. You're teaching, brother." Okay, appreciate it. So that's the way I look at it. If I had $30 a day, I'm going to get a bigger bang for my buck with Uber, even though Lyft is doing a better job of managing their debt. They seem to have a little bit more growth, but I got to give Uber the brand. I got to give Uber the revenue streams, and I got to give Uber through the size. So when it comes down to hard times like this, 3 things happen to companies. They get stronger, they try to survive, or they just disappear. So the companies that are going to disappear are the smaller companies. I think a company like Lyft and Uber, I think both of them will probably make it through. But I think during this time, Uber is going to get stronger because of its multiple revenue streams. Uber doesn't have one revenue stream. Uber has three revenue streams. It has Uber Eats, Uber Freights, and it gives rides. Even though both of the companies reported that they both had a hard time with rides, guess what happened with Uber? Uber said, hey, yeah, we had a hard time with rides, but that's not our only way of making money. So now let's take a look at where did I get my information from. I have it pulled up here. Make sure we got this right. So what I have pulled up here, this is the Lyft, right? This is Lyft earnings as of March 31st. You can see right here, it tells you right here. This is on the SEC.gov. So they're right here, they're telling you this is their active riders. This is how much money they made in the physical year. They grew year over year by 23%, which was more than Uber. And then I get to see right here exactly what the CEO is saying. That's important for me. That's guidance. That's the future, what the CEO is saying. And as you scroll down, ladies and gentlemen, you can see all the assets. This is where I got the asset numbers from. The current assets, the cash, all of the good stuff. Then as you scroll down some more, you can see their total assets are here. Their total liabilities are here, and their net worth. I didn't even bring that up. Shareholders' equity is called net worth. Net worth is $13 billion for Uber and $2.6 billion for Lyft. So a net worth is total assets minus your total liabilities, was also called your total shareholders' equity, right? So here you got the revenue streams, how much money they lost, the net loss right here, right? That's where I got that from. So right here, this is coming exactly from what Lyft said about, I think it came out last week. So this is what Lyft said. So this is what I'm getting from. This is called the 10K report. They reported in an 8K, 8 kilo. This came out on May 6th. May 6th, they talked about their earnings. So this is where I got all the information from right here, right? And I love to teach people how to fish to where they can look up their information as well. He said, do you look at their technical analysis or the fundamental records? I look at the fundamental records. It's always golden. You always hear in finances, fundamentals tell you what to buy. Technical tell you when to buy it, right? So before I even look at the technical data, I got to look at and see if you're even worth buying, right? So a lot of people just look at the price, go off the company, but this one teaches you how to, looking at the financial records tell you the fundamentals. This is a good company to buy. Now I can look at my technical data and see when I want to buy it, right? All right, good evening to you as well. So that's what I would have. Me personally, when I look at it, I boil them both down. I look at the finances of both of them, both of the companies. Uber's a bigger company for the same price. If I had $30 today, if I had to bet onto their particular future, I like Uber because it has more, it's bigger, it has a stronger brand, it has multiple revenue streams. But Lyft on itself, even though it's way smaller, is doing a better job at managing its debt and its growth. So, but I would have to give my hat tip to Uber. Even though Lyft was beating in some things, it wasn't beating anything drastic that I was like, whoa, this company has way more cash, and I've seen that before. So when I have to tie those two together, I got to give the winner to Uber. Hope I didn't beat a dead horse on that. So, okay, great, thanks. All right, so that's going to conclude today's episode. We talked about unemployment was rising. Unemployment rose to 14.7%, but we're seeing the market kind of sit the same or kind of moving up a little bit, and that's giving a lot of questions to people. And my belief is that right now we're in a time where we don't know what's going to happen in a month. Usually, the stock market prices indicators are a leading indicator, meaning that they'll tell you where the economy is going. They don't tell you where the economy is at. They tell you where the economy is going, right? So a lagging indicator is things that come up that happens behind something. Like unemployment is a leading indicator. If you got bad unemployment, that means the economy is probably going to a bad place. Now you can look up LEIs, leading economical indicators. It's about 9 of them. But go to the conferenceboard.org. The conferenceboard.org. They put out a monthly report on the LEIs. They do an index, their leading indicator index, right? Where they take all the leading indicators and they kind of give you a good indication of where the economy is heading. So the stock market is an indicator of not where we're at today, but where we're headed. Right now, the market is kind of teetering. It's moving to the side because everybody is wondering what's going to go on. I think we're going to see a massive swing to the upside or the downside here shortly in about a month or two, right? Because right now, everybody's like, okay, we're kind of reopening. Are we going to have a vaccination? What's going to really go on? What's going on with airline stocks? Everybody's kind of uncertain. They're kind of optimistic, but they're not really optimistic. So the market is kind of teetering along like this. But once people kind of make up their mind, like, oh, crap, here comes a recession. We're already, ladies and gentlemen, we're in a recession. I don't know if people notice that, because the recession is defined by 2 months of 2 quarters of declining GDP. January, February, March, GDP came out, and that was already a decline. We pretty much was shut down for majority of February, so you already know that the second quarter, which is April, May, June, is going to be another decline in the GDP. That right there is textbook a recession, right? So the market's going to swing one way or the other. I'm not sure of where it's going to swing. The reason we're moving, we haven't seen any major jumps already. Unemployment, yes, it is high. Yes, people are not working, but the market has already cooked this stuff in when you saw us go down to 18,000 points in February. But anyway, ladies and gentlemen, that's going to conclude today's topic, today's episode. Thank you for tuning in here on Facebook. Also, catch me on YouTube. This content is uploaded on YouTube on the Investor Show as well. Also on the podcast, the Investor Show, which is streaming everywhere you can find out, right? So anyway, thank you guys and girls. Until the next video, podcast, cartoon, or whatever else crazy you see me do around the globe. Peace. Be safe. I'm out. Thank you.